Hey everybody, Brian Shannon here from alphatrends.net. Today's Friday, the 16th of May, 2014. Hope you had a good week of trading here. The S&P 500 finished with a very small gain and remains in the year-to-date positive column. Nasdaq was up a percentage point, so we're back to positive for the month, but not quite for the year. And we saw some further selling in the Russell 2000. Not a whole lot, but financials got hit the worst, and the bonds continue to be really strong here. So let's take a look at the chart and see where we are and where we have the potential to go. The S&P 500 did break out to an all-time high and closed up there on Tuesday, and then we saw that on Wednesday and Thursday we pulled back pretty hard. And this is something to be aware of, that a lot of times the breaks to new highs will come with a sharp pullback. And here's what we're seeing right now: is it's too early to say it's a failed breakout, but if this market can't hold above the 50-day moving average and really the support down near 186 to 186 and a half, then you have to think that maybe the S&P 500 would be in a little bit more corrective mode, perhaps down to this trend line that I've just drawn in. Longer term on the weekly time frame, so we're still clearly in a very strong uptrend here, and we're touching this trend line a little bit more often. I think when that trend line eventually breaks, that it'll be something definitely worth to keep an eye on. Trend line breaks don't mean the market is reversing, but often that the rate of ascent is slowing, and we're seeing the rate of ascent clearly has slowed here this year, with this market only up 1.8%. We've had some volatility, but and we're still positive, of course, but we're just it's tough to have confidence in long or short side for very long here. So next week, what's going to be important is 189. If we can get back above and hold above that 189 and a half little band of resistance, then that's where we'll see this market should be able to continue to rally. However, if we break down below that 186 to 186 and a half band of support, then I think that we could see the beginning of a deeper decline. The 50-day moving average, that's the green one in here, let me just clear those lines off, has been being touched here for the last several weeks and still manages to close above it. I think getting and closing below it could be a little bit more dangerous. So we have to go into next week very cautious still. The Nasdaq, which had broken that first little band of resistance at 88 to 88 and a dime, did fail as well. So we had this market look like it wanted to break out. We do have a declining 50-day moving average, and that's generally not a good thing to see. So for this market, again, we're going to need to see it clear this week's high up near about 88.50. If we can get back above and hold above 88.50, then I think we can add to the gains in the Nasdaq. But it's just super choppy in here. Keep an eye on some of these little trend lines that look probably more like this. Let me just delete that other one. But off of the April lows, this little trend line in here is going to take on some significance. If we break below this week's low down at about 86 and a half, then it seems to me as though we should probably be heading for another test of 85, perhaps even down towards that 200-day moving average, which is currently at about 84.25. So the bottom line for the Nasdaq is cautious. You have to be very aware that breaking down here could lead to further decline. The Russell 2000, obviously this market has been the weakest. We've seen a bigger trend line break on the weekly time frame here a couple weeks ago. We've seen also that we've been closing below that 200-day moving average. The 50 is below the 100, and this week we saw a test of the lows that we saw from the fourth quarter of last year and the first quarter of this year, down in about this 107 level. I think the 107.27 was the low that we have seen this year. But the clear picture here is that we still have a pattern of lower highs and lower lows. We made a lower low on Thursday, and now we're seeing a little bit of reprieve from that here with today's rally of 0.2%. But clearly we're in a downtrend, and this rally cannot be trusted, not with a declining 10, 20, and 50-day moving average. It's going to need some time to heal at least. Perhaps next week we can continue up towards 110.5 to 111. That's been an important level, and if we find resistance there, then a breakdown from that level may provide another short opportunity in the Russell 2000. We are down pretty significantly in the Russell from the highs. It's probably, what is that, about 10%, right? So we're down about 10% from the highs, and maybe it's just going to need some time to correct in here. So don't be looking to just get bearish automatically if we break below these levels, but because we've already come down a pretty good level. But be aware that further selling is likely to spill into other sectors, other areas of the market. The semiconductors have been really holding up well above the 43.5 to 44 level. That's also, as I pointed out this week, the approximate area. The purple moving average, that's the volume weighted average price year to date. So starting on the first day of trading this year, January 2nd, the average price that the semiconductors has traded for, adjusted for volume, is $43.86. So that adds significance to this level. But 43.5 to 44 is really the band of support that if it breaks that, then I think you'll see that the pressure's been building on these semiconductors, and if they can't hold this support, then I think you would see a pretty quick little sell-off, perhaps down towards the 43 level or so. By the way, let's go back to that Nasdaq chart, because the Nasdaq chart, you can see we've been struggling in here with the volume weighted average price year to date. And that's currently at 87.47, so just a very indecisive year so far. S&P 500, we've got the volume weighted average price down at 184, which is also, as you can see what I've drawn in here from the other day, is from the lows that it saw in January to the highs this week, a 38.2% retracement would bring it down to 184.13. So any deeper pullback in the S&P 500, that 184 level should be an area where the market should be able to catch some support. It doesn't mean that you would want to buy there, but that's an area to look for the potential of support if we do see further decline into next week. The semiconductors we just covered. So let's look at the financials now. Financials have really kind of been trading sideways more than anything. We've got this, well, I didn't really mean to draw that Fibonacci. What I meant to do was draw a trend line off of these lows from April of last year, and you can see this trend line it keeps getting hit, and the frequency of these trend line hits becomes greater as well. We've got this prior area of support up in here. Actually what was resistance turned into support, and then back to resistance this week. Breaking this trend line and below the lows right here at about 2150, I think would likely bring the financials down to the 200-day moving average at about $21.20. So the financials were below a declining 5-day moving average. We've got this little band of support that we're in here, 2150 to 2160. So breaking below that next week, I think would lead to a little bit further unraveling in the financials. So again, the theme is that it's pretty indecisive. We don't know if this market is just churning as it undergoes distribution before a larger decline, or we're sucking in a lot of shorts here, and the possibility is that they can get squeezed higher. But for now, with these markets below key moving averages, in particular the declining 5-day moving averages, we want to be very careful about the near-term outlook of this market. And if we break these bigger levels of support, then you want to get a lot more defensive. Gold continues to just kind of do nothing in here, and as I like to point out, if they don't scare you out on the way down, they'll typically wear you out, and I think that can be said for a lot of these momentum names that have broken as well. The TLT, this is the bonds. My friend JC over at All Star Charts, he's been bullish on the bonds pretty much all year, and that was a great call because he was definitely in the minority. But you can see here on the weekly chart where officially, in my mind, became good to be or okay to be bullish based on price action was as it broke at about 108 level, and now we're coming up to a potential area of resistance. Doesn't mean it will be, but this market's had a great run, and this year we're so far up 11.5% in the TLT, and you can see here the bigger winner too is the IYR. That's the commercial real estate index. The IYR has had a great year, up what it was at 12.5% or so. Obviously a beneficiary of lower interest rates. Apple made a real nice run into the close today. They've got their stock split coming up, I think, June 2nd, 7-for-1, is that right? Anyways, Apple remains in an uptrend. It's digesting these gains really through time and holds on. We saw a little shakeout and now a higher low. So Apple's still in a good uptrend, and I think that if you're you're a intermediate term trader, that your stop probably ought to go under about this level. Twitter this week lost a little bit of ground, and we can see that what I wanted to point out was the volume weighted average price since the event. The event, of course, being that gap lower on earnings, and this is, this automatically draws it in. You can see that line coming in, and the volume-weighted average price since earnings is $32.67. So the average participant who's purchased after the earnings is down by about 40 cents. Not a big deal in here. What I would personally like to see happen in Twitter would be for us to come down and undercut this low just by a few pennies. At that point, it might create enough panic and flush the stops that it could turn back around higher, but still it's clearly in a downtrend, and the odds just don't favor good trades when we're buying stocks in downtrends. At Alpha Trends today, we were looking at DGX. This one still looks like it has some room to run. TSO, this is Tesoro, it's breaking some little short-term consolidation in here, and it's got a nice looking longer term chart. There's the weekly. Here's a 30-minute time frame, breaking a little bit of resistance here above a rising 5-day moving average. And VLCCF is one to keep an eye on for next week, as it's been consolidating in a pretty tight little range here, building this little flag pattern, or pennant, I guess would be more appropriate to call it. Had a very low volume today, but 627,000 shares average daily volume, and VLCCF looks like it has some room to run. That'll do it for me. I'm going to be out all next week. Hope the market does nothing and provides me a whole bunch of good setups after Memorial Day. But if you're trading next week, I hope it's a good week for you. Take each stock based on its own merits. Don't trade the mid caps based on what the Russell 2000 is doing. Trade the mid caps based on what the mid caps are doing. Trade gold based on what gold is doing, not what on the dollar is supposed to be doing or what relationships are supposed to be there. We've seen this year that a lot of these relationships aren't working out, and you're much better off managing risk on an individual basis for each stock, for each ETF, or whatever it is that you're trading. That'll do it for me. Thanks.